Ladies and gentlemen, it's time for another episode of What's on Your Mind. And this time I've got Edward Shek and Anthony Iser joining me. Now, these guys have over 50 years of professional trading experience between them. So we're in luck today. We're very fortunate to hear from them. And guys, I look forward to listening to what you have to say today about markets and also ideas that you've been thinking about in your own portfolios. So with that being said, Anthony, take it away.
Thank you, Chris. Hello, Ed. Hello, everyone out there. I am in not quite so sunny at the moment, Phuket, with Anton talking to a few mentees about processes and how we go about things here at the Institute. But I do want to talk about a few ideas and what's been on my mind recently. And I'm going to start with a macro and try and sort of set the scene for my first idea as well. So I'm of the view that this current rally that we've seen from June lows, mid-June through to now, is a bear market rally. And if you have a look at this first slide here, you'll see that this is a pretty standard bear market rally. They tend to have 50% retracement of the first decline, and that's happened for all major bear markets since 1929, as you can see, the dark line being the current one. The reason why I think we're still in a bear market and that this is a rally and not a start of a new bull market is really to do with interest rates, Fed, inflation, and all those big macro things that are going on at the moment. So if we look at this second chart here, you'll see that real rates are still deeply negative. Historically, when we've been in these negative numbers, you can see those grey lines there, the grey bars on this chart. They're recessions. And at this point in time, we're in a very technical one, but not a full-blown one. And I think the risk is we wind up in a full-blown recession. And that's going to drive earnings lower. It's going to drive the market lower. Now, I may well be wrong on this, but I suspect I'm not. And the balance of probabilities for me leans strongly that way. Okay, so why is that the case? Why do I feel this way? Well, we look at this next chart here. This is inflation, and the market is starting to forecast a reasonable decline in inflation. And we saw a CPI number that was a little bit more benign than expected in July. The markets rallied hard, and expectations of Fed rate rises moved from 75 basis points in September back down to 50. And now it's sort of pushing back up again. But you can see from this chart here, the market's broadly got inflation wrong for a long, long time. And all the forecasts always revert back to that 2% level. It will get there eventually. I just don't think it's going to get there as quickly as the market thinks. And as a result, the Fed's going to have to raise rates a little harder and a little faster than is currently built into expectations. So what are those expectations? Looking again at the next chart here, we can see that the market's looking for Fed rate to peak out around about 3.65% in December. Well, I think that number is probably going to be a little higher. And more importantly, I think it's probably going to push back a little further than December, January of this year. And that's going to put real pressure on the economy, and it's going to put a real pressure on the markets. So we've got a few charts here. Hopefully, some of the these are making sense in terms of setting this macro scene for you of what I'm thinking at the moment. But you can see the red dots and the dates on this chart. We're way out to the right in uncharted territory, with CPI on the bottom axis, 10-year yields on the left axis. And we've done a big sort of loop, November, December, January, through round to July. But historically, anytime CPI has been at these levels, the 10-year bond has been substantially higher, 6, 7, 8, 9%. And that suggests that one of two things has got to happen. Either the CPI is going to fall dramatically, getting us back to an appropriate level for the current bond yields, or maybe rates have got to go up further and faster and harder, and those bond yields can start picking up again. And again, very negative for the economy, negative for markets. And I think that is where the risk is. So what happens with inflation in the next little bit? Even if we see zero inflation, and inflation's a month-on-month change, so August will drop out, the new August will come in. If we see 0% month-on-month for the next 4 months through to Christmas, you can see this dark line and then that bottom green line on this chart. We're still going to be sitting here at Christmas with inflation at 6.3%. I struggle to see how the Fed is going to be looking to pivot to cutting rates at that point in time if we're at that number. Now, of course, those forecasts it could be wrong. We might see negative inflation coming through and that falls faster, in which case, we'll change our view. But for me, at this point in time, I think rates are going to be higher for longer. And that sort of sets the scene for earnings and earnings risk. And at the moment, the S&P earnings growth last quarter came in at 6.7%, except that was driven purely by energy. Taking energy out was minus 3.7%, suggesting underlying issues for the economy. And energy prices have fallen. The tailwinds on earnings from energy, I think, are going to disappear. So we've got earnings risk to the downside, and I think we've got market risk to the downside. So we can see these earnings declining from consensus at the moment of 244 for the S&P, and currently on a PE of 18 times, 239 and 18 times gives us our 4,300 for the market at the moment. I think those earnings are really at risk of falling towards 200 for the S&P. We would see multiple decline as well. And you can see from this chart, that's how we would get back down to a level that's testing those lows of June. I struggle to see how this chart moves towards the top left. I struggle to see how earnings are going up in the short term. And one final one on this front, historically, there's the rule of 20. Trailing PE plus CPI below 20 is needed for a market bottom. And you can see the market bottoms in these orange lines here. What happens is, or where we are now, I should say, is well above that level. So just because it's happened in the past doesn't mean it has to happen in the future. But again, the balance of probabilities suggest to me that we need to see that happen. And that's going to happen with CPI probably falling a little bit, but more likely to see the PE multiple for the market falling substantially. Okay, let's get a little bit more specific, and this leads into my idea. Housing. US housing is under quite a bit of pressure, I think. The first chart here shows that the bulk of mortgages are set below 4%. Now, what that means is people are going to be reluctant to trade up. I'm not going to sell this house and buy a new one, a bigger and better one, because I'm suddenly going to be paying 5.5%. So they'll do upgrades by stealth. We'll go and get a new kitchen, a new bathroom, add to that mortgage, but it's at those low rates. What that does is take demand away from the housing market. And when housing market sees demand come away, prices start to fall. And you can see here that 54% of home builders surveyed just in this last month have reduced their prices by 1 to 5%. 23% have reduced by 6 to 10, 6% by more than 11%, and only 17% of home builders showing no signs of reductions. This is negative for margins. Okay, couple of things quickly before I get stuck into the specific idea. Atlanta Fed, home affordability, huge decline, a 28% year-over-year decline in June. And that is probably better reflected in this final chart here, showing that threshold of affordability, 30% of your income. Currently, across metro area in the US, we're looking at 44%. Across the US as a whole, it's 42%. Things are stretched. Okay, one final snippet in terms of the housing market, just to set the picture of why I think this is a real risk to the downside. January 2021, 30-year mortgages, about 2.5, 2.6, 2.7%. Average home was around about $400,000. Currently, that mortgage rate's kicked up to 5.5% to 5.7%. The new home price has also gone up a lot, lots to do with costs, $550,000 roughly. So 20% down payment, pretty standard. That means your monthly payments have gone up almost 100%, about $1,300 to about $2,500. That is crimping demand, which leaves me to my idea. So my idea is to short Lennar. Now, we've had a couple of bits of data in the last couple of days that are giving me increased confidence on this. July new home sales just came out. They're down 30% year over year. Median prices were up. Of course, we've got costs going up. So that's one offsetting factor. But we've got costs going up as well. So margins are still under pressure. Also, supply of new homes has gone up. And again, that supply-demand dynamic moving in favor of the buyers. So a couple of final things before talking about Lennar specifically. One catalyst we always look for is what are the other stocks in the sectors doing? Toll Brothers just reported. Cancellation rates gone from 3.1% to 13% in Q3. They made the comment, as our third quarter progressed, we saw a significant decline in demand as the combined impact of mortgage rates rising, home prices, stock market volatility, and macro uncertainty saw buyers step aside. They went and cut their outlook, 11 to 11,500 homes down to 10 to 10.3. So I'm expecting the same thing to come through from all these other sellers, and in particular Lennar. Now, I won't delve too specifically into all the details of Lennar because this is really a macro trade. It's driven by all those things that I've just discussed. But the point with Lennar is it is the largest home builder in the US. It makes homes across the range, from lower end to higher end. They've got some multi-homes as well. They are geographically spread out across the US, although 40% is done in the West, 25% in the East, a big exposure in Texas of 12%. Now, I think earnings and sales are going to be under pressure. Sales growth with 2 quarters to remain in this year is expected to be up 25% on last year. I think that can get crimped and subsequently further declines coming through after that because we've got sales only down 6% next year and flat the year after. So earnings, obviously quite a bit of leverage in these types of businesses. So we've got earnings down 14% next year on sales decline of 6%. If we see sales decline of 10, 15, 20%, which I think is possible, then that sales number could really get cut. And that's what I think is going to drive the stock lower. Okay. At their last quarterly number, they provided a little bit of guidance, although they made it quite clear the guidance was hard given all the levels of uncertainty. But effectively, they're looking at 68,000 homes for the full year, maintaining their previous guidance. I would not be surprised to see that get cut, particularly on the back of the 10% cut that Toll had. So what have we got? We've got this big macro issue going on here. This is clearly a macro trade. You could potentially look at a whole range of stocks in this sector. I think Lennar is going to be under particular pressure because they do a lot of volume at lower prices, and those that segment of the market has been disproportionately hit by this inflation increase and the rising costs. So what have we got coming up? We've got results on the 19th of September. We've got the Fed meeting coming out a day later. I think that risk is that 75 basis points comes through and a clear focus on killing inflation, even if it's at the expense of the economy. What does that mean for earnings? Well, under recessionary periods, the last period we had was the financial crisis. It's not going to be as extreme as that. But their EPS went from $6 profit to $3 a share loss. The share price went from 50 to 3. I'm not expecting anything like that. The stock's around about 80 at the moment. I'm thinking a price target of 60 can come through. And I've got a trade structure I think is going to take advantage of that. So with results on the 19th, I'm looking at buying a calendar spread, potentially a cheeky one with 23rd of September options. So buying 2 units of that, selling one of the 9th of September, buying for $3, selling for $1.80. I've got an outlay of $4.20 per share for that structure. Now, if my timing is wrong and my move is correct and it does go down to $60, I'm still looking at a 3-to-1 payoff here. If my timing is exquisite and that first leg drops out, then my payoff is going to be significantly higher because I'm going to have double the exposure. The final thing that I am considering at this point in time, though, is I could double my cost, which is not ideal, but it buys me 2 months. And I could take that buy leg out to November. I can potentially get some other credits to reduce it, but I can go out to November and add in a whole range of other catalysts, lots of them economic, with consistent news coming through that we're under pressure, and of course all the other building companies reporting and giving an outlook that's pretty negative. So that's a fairly big sort of download on macro, trying to take it from the big picture down to a stock and execution. So Ed, I know I've just gone bang with a big ramble there. How are you seeing things? And is it anything like that?
Yeah, no, I mean, very nicely illustrated, and I'm in complete agreement. And I'm going to have a quick chat about macro, but I'm very much, set up short. I'm a definitely sell the rally trader at the moment. And I'm going to just move on from what Anthony says and frame it in a slightly different way. But I think Anthony started at the right point. Be aware that if CPI month on month is 0 flat for the next 4 months, you will end year over year in December at around 6. So assuming the Fed funds rate are at 3.5, the gap's down to 2.5 points, and it's currently at 6, right? 2.5 to 8.5. Jerome's going to be pretty pleased with that outcome, because then he really can say we're approaching neutrality. Now, for reasons I'll mention very briefly later, clearly the risk, well, in my opinion, is that the risk of inflation is to the upside. But my bearish view, and this differs from someone like Jan Hatzius at Goldman's, is I think this market's slightly too over-obsessed about what terminal rates are. And when we saw one of the drivers of this bear market rally was obviously, well, if we go through 3 quickly, results weren't as bad as expected. That's very different from upgrades, and they're good. 2, extreme positioning, loads of short covering. And 3, although this has corrected slightly, this ridiculous notion, in my opinion, that the Fed might be cutting rates at some point next year is fueling a risk-on rally. Now, of course, partly that's unwound now because the 10-year's gone above 3. Let's say inflation is as good as we can expect, and terminal rates are 3.5, right? And the market's comfortable, the bond market's steady. Where I differ with Jan is that I don't think that that's a bullish indicator. This market's obsessed by terminal rates, as if when we could say with certainty, yeah, rates are going to peak at 3.5, and of course I think they could be higher, like Anthony, maybe even 4. But let's say they stay at 3.5. Why is that good for profitability and margins? And I think this market is still drunk on and forgetting that the primary driver of the last 15 years rally has been based off QE. Huge amounts of liquidity, extremely cheap money, and this put that just doesn't exist. All right, we think if things get a bit tough, Jerome's going to cut rates. Well, maybe he does. But the way I think is, if he does cut rates, if the Fed cuts rates like within 9 months or mid-2023, do you really want to buy that market? Because all that means to me is we are having a hard landing. Now, my only reference is when you look at 2017-18. Fed funds rate got up to 2.5%. It stayed there for about 4 months before growth disappeared. Inflation, there wasn't any, and that was the problem. The Fed starts cutting rates down to 1 3/4. Then we had COVID, and we know the story from there. So rates got up to 2.5 and it choked off growth. And that was with the Fed being able to reverse very quickly. When we think of the setup now, we're going to have terminal rates 3.5, potentially higher, right? We've got material structural supply side inflation, which in my opinion, and of course it's going to change, but there's a lot of data dependency here. But where we stand today, there's too much supply side, which is going to limit his ability to cut rates, right? So not only are terminal rates going to be at least 100 basis points higher, you can argue the economy is slightly less leveraged, but the amount of debt in the system is far greater. So I think the drag on growth is going to be greater and the ability to cut rates is not going to be there. And if he does cut rates, you don't want to be long risk assets. So I'm bearish. I've told you I'm going to sell rallies. My first idea or my two ideas are going to reflect that view. But I think it's also good to remind yourself why you're bearish and what my triggers are that will change my view. So if there's a rally, I mean, Jackson Hole this Friday, let's say he manufactures some dovish view that the market buys and we go on a risk rally, just execute my plan. Try and make sure I don't get longer in a rising market and scale into shorts, be patient, be ready when the market turns. But for me to turn positive, what I really need is a few of these things to happen. I need real wages turning positive, need productivity, and the numbers were horrible, to improve, increase investment, quality job creation, obviously, and inflation falling more rapidly. So there's a big difference between buying a market because you think it's not as bad as it could be, and a beginning of a new bull market, which needs to be based on real wage growth, value-added job creation, more in purchasing power, and obviously a reduction in yields. None of that's really on the cards. Now, when you're looking at the data, this narrative is still, you look at the jobs data, how strong it is. Last jobs report. Jason covered this really nicely. It's not a strong jobs report. Real full-time jobs are going down. 100,000 people are needing second or third jobs. That's not a position of strength. You look at the credit reports, biggest issuance of credit cards to consumers since 2008, all young, all lower income. So what does that mean? Yeah, you're struggling to get by month on month. You ship in a few new credit cards with a grand limit. You use it to roll debt. Is that a credit expansion based on good fundamentals? No, it's just a sign of potential problems ahead. Retail sales always make me laugh. We're obsessed with this notional, how good retail sales are. They're not good. If you're lower income and you've got £2,000 a month to spend, you're spending that every month, whether inflation's up or inflation's down. It's just a function of how many goods can you purchase. We had Walmart results, right? They beat. Great. The narrative shows how strong the consumer is. Rubbish. The reason why they beat is they said we're getting a lot of new customers who we've never had before. So people are going lower down, looking for value, which is great. You want to save some money, you can do it if you buy some of your stuff at Walmart. But that consumer spending is coming out of the middle sector. Productivity numbers are absolutely horrible. So when you're looking at the data, don't just look at the headlines. You've got to look at the breakdowns, and then you've got to make your assumptions. The narratives are very misleading, as always. And obviously, as this market rallied, of course, all the narratives start to get more positive. Right. My first idea, very straightforward. FMC Corp. It's a $14 billion agricultural services company. 5th largest, sells into 120 countries, nice easy business, 3 segments: insecticides for the pests, herbicides for the weeds, and fungicides for the shrooms and the spores. It deals in crop protection, crop enhancement, turf management. It's got a really nice geographical mix. LATAM's 32%, Asia's 25%, North America 22%, Europe, Middle East, Africa 21%. So it's global. It's seasonal, covers all the, obviously, crop yielding situations across all time zones. By product, insecticides 60, herbicides 27, fungicides and the rest 13. Quick sector overview. Now, clearly, One big structural tailwind, unfortunately, is climate change. I think only yesterday I saw that the Brazilian coffee harvest could be 40% lower yields because of their problems. China's having a lot of problems. We're hearing about the European drought. We know that their rivers are running dry. They've got a bad drought. They're worried about their crop harvest. I could go on. But no farmer is saying this climate change thing's really helping. These changes in weather patterns are increasing yields. It's all the other way. Now, clearly, one of the big drivers of CPI, when you think about it, is food. And this is one where we've got a structural problem. We've got food inflation that no amount of increasing interest rates is going to make any difference to crop yields. So food security, food inflation is at the forefront of governments and growers' minds. And this is a tailwind to the business. In terms of the market size, it's growing, steady but not spectacular. This is that sort of low beta stock, right? Insecticides, $19 billion market in 2020, or greater 30 by 2029. That's about 6% compound annual. And in the crop protection, 63 billion in 2020, 74 by 25, only 3.1%. But I think the risk is to the upside as we have to chase higher yields for our foods. Now, when you have a look at the quants, 2022 looks pretty average, right? Revenue growth up 12, earnings growth only 7. So this isn't the operational leverage I'm really usually looking for. When we look forward a year, revenue growth up 5, earnings growth up 14. So then the earnings leverage is starting to improve. From a valuation perspective, trades on P of 15 this year, 13 next, nothing in that. It trades at a premium on an EV to EBITDA measure, 10% premium to the other stocks in the sector, and some of them are larger. And I think that's warranted because it's got better catalysts. Now, you can look at year-on-year numbers, you get the trend, but the direction quarter to quarter is really important. So although they've had a bit of margin erosion with costs, when you read last quarter, which was Q2 a couple of weeks ago, they said that their costs are coming down Q3 and pricing's going up into Q4. So I think the improvement of operating leverage is literally happening now. That's why I'm happy to purchase this, on top of the reason, of course, that it fits my macro view and I want a bit of defensiveness on the long side. Right. Insecticides is the most important. It's 60% of their business. It's got 2 main products, rhinazepor and thiazepor. That's 40% of sales. Without getting into chemistry, these are diamide insecticides. They're slightly toxic. They're the best of a bad bunch and necessary evil, but they are toxic to humans and mammals. FMC is at the forefront of the evolution into pheromone insecticides. So where the toxic ones just kill them when they're there, this is trying to mess with their reproductive systems. It's biological. It's trying to reduce the number of pets. Biological versus chemical is very much the future. We need less toxicity, greater yields. This company recently bought this Danish company, BioFero, for 200 million, that puts it right at the forefront. Now, in terms of commerciality, it's starting to happen because due to biotech improvements, the cost of creating these pheromones is coming down a lot, making it a genuine commercial viability. So I think this is where the growth is for all this sector. This company is at the forefront. Now, commerciality as it stands now is really a year to 2 years away. I need a catalyst for 2 or 3 months. There isn't an obvious catalyst. However, any developments in this space should excite the market as much as you do in agricultural chemicals and hopefully see a bit of multiple expansion. Now, patents are very important. Obviously, they give these companies a moat. This company's got a 200 US patent, 2,700 European, and it's got 1,700 pending, all to do with the pheromones. So it gives the business a nice moat. It means you can't have generic copies for years. It gives you good visibility, slow and steady and visibility, good sector tailwinds, new products coming through, and that's your lot. So I think it's the best stock in the sector. It's got the best growth prospects. Total addressable markets are growing, but nothing spectacular. What are the risks? It's a global business. Strong dollar's not going to help. Then obviously margins will be affected by input prices. Stocks at 135. Next earnings November the 1st. only October or January options are available. Now, January obviously gets you earnings, but it's too long duration. Even with the low vol stock, it's a bit too lazy. So in this situation, I always go for a holding position. So that means I'll trade short of the catalyst. I'll buy October, sell September, just for set up a ratio calendar call spread. But as soon as November options are available, I'm going to roll it. And if when November options are available, this position's losing money, I cut it and use the remaining capital to get into the correct structure. Don't be the sort of trader who thinks, I'm not going to roll this, restructure it until I'm up or flat. That's just daft. You then get caught in a trap where you might end up not being able to get a big enough position. So the macro, I'm totally in line with Anthony. I think the risks are very much to the downside. And this first position adds a bit of defensive, steady growth to the book.
Good stuff. Fantastic depth from both of you in those ideas so far. Anthony, let's go back to you. You obviously covered a short first. What about on the long side? Are you thinking of anything there?
I am, Chris, and like Ed, the focus is on margins and companies that might be able to have operating leverage, and particularly very steady earnings in these volatile times. So my short idea was obviously heavily macro driven, huge headwinds that I'm expecting for construction companies. This idea is more thematic with sizable tailwinds. So the company is Fortinet. They're in cybersecurity. It's a $40 billion company. The share price is $50.59 as we sit here sort of pre-market on Wednesday. Valuation-wise, next 12 months, PE is 43 times. We've got sales growth of 30, 20, 20, and then EPS growth of 32, 23, and 23 for the next couple of years. Now, like a lot of high-quality tech stocks, it has seen that valuation derating from those peaks in November last year as the market grappled with initially pending rate rises and subsequently real rate rises coming through, impacting risk sentiment as well as DCF and valuation-driven models. So the PE has come from 83 times down to that 43.5, so fallen in half. Price to sales, similar, 15.8 down to 8.4. The share price has fallen from 73 down to the current price of 50.59. Clearly, it hasn't fallen as much as those multiples have, and that's because earnings continues to be strong. Now, they reported just recently, the stock fell 20% on this earnings result. So initially, when I looked at it, I was a little bit cautious, trying to understand what had driven that. And it seems that it's largely expectations. There was expectations that there would be upgrades coming through, and they didn't come through. And then the other area of disappointment that saw that decline was services revenue declining. Now, I'll talk about the business in just a moment, but their services revenue was cut by 1%. And the guidance cut by 1%. This to me is not a huge deal, but the market had clearly factored in these numbers to be upgraded. The explanation that companies given for these cuts make a lot of sense to me. It's threefold. One is Russia put a line through that part of the business. Second thing is customers are delaying their starting date for their services contract. So it's becoming deferred revenue. It's going to happen. They've just pushed it out a little bit. And the third point is this is a hardware and software business. There has been supply chain issues. So the hardware has been slow coming through. Needless to say, the service contract comes after that. So again, just pushing it out. Deferred revenue, not declining revenue. Interestingly, despite this, after this result, analysts upgrade both sales and revenue. So I feel reasonably confident that this is an explanation that suits what's happened and that small decline in services revenue. Okay, So what do they do? Cybersecurity is the big picture, but this is a twofold company. They do hardware and they do software. So hardware-wise, they have firewalls, and they look like this. This is an email router firewall, and they've got routers and firewalls like this that is hardware to suit all sizes of business, from SME to giant enterprise, to suit all sorts of issues. The second part they do is software-designed wide area networks. So two major components to the business, but all encompassing on the cybersecurity side of things. And they can layer this technology. So you can have your initial firewall, you can have email, you can have sandboxes. And like I said, they wrap this all up in a software-driven network. The business, as Ed mentioned, with the pesticides, highly diversified, gives you confidence when things go wrong. Same situation here. 100 different countries. So while Russia's an issue, drops 1.5% off revenue. Very diversified. 26% in the US. 50% of it comes from 100 countries. On the smaller side of things, major sort of G7, Germany, Japan, UK, France, Canada making up the bulk of the rest. A third, essentially between small enterprises, medium enterprises, and large enterprises. And industry-wise, also very diversified. Government, financial services, tech, retail, making up the bulk of things. Now, this, as you would expect, big market, big tailwinds. This is a $150 billion market and growing by about 10%. Three major areas of growth coming through, or three major segments of this market, all growing well: network security, networking and comms, cloud security, zero trust security, and security ops. Fortinet actively involved in all these segments. And on the hardware side, they've really grown this business to become the clear number one player in the market over the last decade. So if we take this back to 2011, 2012, you had four major players, Fortinet being one, Cisco, Checkpoint, and Palo Alto Networks, all with around about 5 to 10, 15% of market share. As we sit, Cisco's got 13, Checkpoint 7, Palo Alto's been growing from a very low base. They're at 4. Fortinet is shipping 37% of all firewalls. So that's a huge lead into services revenue. So as I said, get that hardware in there, the services revenue follows. So we've got product revenue coming through at a 30% growth rate on that hardware. Palo Alto, for example, one of the major competitors, only growing at 10%. And total revenue coming through, big growth numbers, 26%, quarter after quarter at this point in time. Similar to Palo Alto, but coming from a lower base. Plenty of room to grow. The market's growing, and they're growing faster than all the competitors. So why is the market growing? Well, obvious things really when you think about it. All those warnings that you get from every company you deal with. Ransomware, growing. Cybercrime, growing. Very sort of technical changes in architecture, cybersecurity mesh architecture. That's driving movements towards Fortinet and away from other players. And then probably the scariest one out of all of this, continued state-sponsored attacks. 50% of US chief technical officers believe that this is one of the most dangerous threat to their company or organization. Now, management, we're talking founders, we're talking 25 years across most of the major executive levels. The least experienced people at Fortinet have been there for 4 years with 20% experience in the market. It gives you a lot of confidence that things are going to continue to be this strong, steady growth that we've seen. Now, what's going on with earnings and what happened with that last result? Like I said, didn't surprise enough. The guidance wasn't lifted, but things are going really well. So this is really just about expectations, and that 20% has taken all that expectation out of the stock. When it comes to sales, it comes to earnings, they've got software-like gross margins, despite the fact that a large portion of their business, almost a third, is hardware. So 75% gross margins, operating margins of 25%. The services area, FortiCare and FortiGuard, like I said, make up about 2/3 of the total billing, and that's growing 29% compounded 2019 through to now. We're looking at numbers for this year, 1.7 billion roughly on the product side, about 3.8 billion on the services side. Continued compounding growth is expected. The company is forecasting that $5.6 billion total number to move to $10 billion over the next 3 or 4 years. So what's driving that growth specifically for Fortinet? So I mentioned earlier, it's getting incredibly complex for companies to deal with these types of things, a range of very sophisticated attacks coming through. So companies are trying to reduce their complexity. They're trying to reduce the number of vendors they've got. For Fortinet, offering a whole range of products and services, that leaves them in a prime position to take advantage of that. And that's why they're growing faster than the market. The security network-driven processes are coming through. So that's helping drive additional market share. Broad market, again, the service area attack is growing. And then finally, they're investing a lot in R&D. So they're constantly adding new products, which they're selling to existing customers. And that shows up in their KPIs. So they've got their core platform KPIs, and they've got their platform extensions. So you're an existing customer, you get your core platform numbers coming through, and that's growing at 22%. But the add-ons, the time that they call you and say, okay, we've got this coming through, we've got this coming through, that is growing at 41%, compounded 2018 through 2021. So that's one key KPI for tech companies, and they're really hitting it out of the park on that. The other key KPI is moving up the size of customers, really moving up into enterprise. So we talked about that revenue growth of 31%, and then 20% for the next couple of years. Deals over $1 million in dollar value, billing dollars, grew by 70% in 2021. Forecast to grow something similar again next year. The total number is also growing by about 1/3. So we're getting some bigger deals coming through. That is operational leverage, and that's what Ed and I like to see in the companies that we're looking to trade on the upside. So KPIs doing well, and those core platform extensions is providing all that extra juice. You don't need to go and get a new customer. You're selling an existing customer new products. Okay, so in summary, where do we sit with this? We've got market growth of 10%. We've got sales growth of 31, 21, and 20 for the next 3 years, all looking reasonably secure with these big tailwinds from this industry and from the consistent threats that we're seeing. EPS 32, 23, and 23. So some operational leverage in there, despite the fact that costs are going up on the hardware side. They're hitting all the targets on the KPIs, and the outlook wasn't downgraded. It just simply wasn't upgraded. So we've got this heat that's come out of the stock. The analysts did upgrade sales. They did upgrade earnings. So it really feels like this was just expectations getting a little too far ahead of themselves. So what do we do from here? We look forward to the guidance. We're seeing 31% guidance on billings. We're seeing margins increasing from 75 to 77%. We've got operating margins at the higher end looking to come in at 26%. We've got EPS getting upgraded from 2021 with 80 cents. We've got guidance for the rest of this year, so 2 quarters to go, of $1.01 to $1.05. Catalysts, always important. There's a couple that we can't particularly put our fingers on in terms of timing, and that's industry consolidation. it still remains a very fragmented industry. And with the vendor consolidation, so all those big companies saying, I don't want to have to deal with 12 people, I only want to have to deal with 2, you're going to see big players acquiring smaller players and adding product and services on. And that's going to drive focus, it's going to drive valuation uplift. So we may well see increases in multiples across the whole sector. And so for Fortinet, as the premium player, I would not be surprised to see them actively involved and seeing margins going up as well. Other catalysts over the next little while, on the 7th of September, they're presenting at the Citigroup Global Tech Conference, and the 12th of September, the Comms and Tech Conference at Goldman. Earnings are on the 3rd of November. So what are we going to look for in a structure? So this one, I am going to look a little further out, and there's a reason for that. As we've said, I think the market's at real risk in the short term. So I'm going to put on a more aggressive long structure. So I'm going to look at buying December 55 calls. And I want to try and see through and beyond them. And I do want to capture those earnings. These other catalysts are going to be important, but for me, it's really going to be those earnings coming through, people having comfort that this this services sales number is not an ongoing problem. So the stock's trading at 50.59 currently. I want to buy December 55 for $3.40. Now I'm going to be aggressive and I'm going to sell an October $50 call for $3.80. Now, in an ideal world, I'd sell November and I would capture those earnings without that extra month. So I can always pull that contract, the December one, back. And if there was a November one, I suspect I'd be putting those 2 legs on for about $1 credit. But as it is, it's about 40 cents. But my risk is a little bit different. If the stock was to go up and finish around 50 in the short term, that September leg, the October leg at 50 becomes a little too expensive. So if it was to rally hard, I could be in some trouble. So I want to have a bit of protection. So for $1.70, I can buy an October $55 call. So 3 legs, buying December 55 for $3.40, selling October 50 for $3.80, and buying October 55 for $1.70. It's a $1.30 outlay for 1 unit of that per share. So what does this mean come October? Well, I've got a December price target of $70 here. But if my timing is wrong and maybe the market doesn't come back, this isn't a bear market rally, it is something more legitimate. If my timing's wrong, but my direction is right and this moves towards my price target and is sitting there at $65, say, by October, I've still got a 3-to-1 payoff here. So that's very attractive to have that, even if my timing is not perfect. If it's below 50, then my October contracts expire worthless and I'm long December with an earnings catalyst payoff. And I can always bring that forward to November and pick up a credit. And so if it hits my target price after that, after these October ones expire, my payoff is quite large, a 10-to-1 payoff at my $70 price target. And obviously quite substantial, even if it only gets to 60 or 65. So where is my risk then? Well, as I said, if somehow the stock just travels sideways for the next 2 months through to October and we finish at 55, I'm probably going to be down a fraction more than that premium. I'm probably going to be down a total of about $2 a unit. So why take on this risk? And the reason why I think that risk is actually quite small is we've got a couple of months and I'm expecting a lot of volatility here. So I don't see the risk as being particularly big. And even if it is, it's not extreme by any means. So what could happen between now and then? We could see the bear market sell-off that I would expect, that if the Fed is going to raise rates higher, if we see things come down, and there's a very good opportunity for this to close out below 50. And if it happens sooner than that, I can buy back that short position and be in an all long position all the way through to December. Or if it goes the other way, that's fine. I'm structured in a way that if my timing's wrong, but my direction's right, I'm still profitable. And that's the thing about trade structures. We're always trying to find something. Every trade structure has a trade-off. what are you prepared to trade off? And in this case, I'm prepared to trade that little risk if it drifts sideways, because I just don't see in this market how volatility disappears and a stock like this sits there at sort of 50 to 55 for the next 2 months. So I'm going to have an opportunity to stay active and trade my way out of this into an even better position. So Ed, there we go. I've got sort of a little bit of margin expansion, but I feel very comfortable about my top line growth on this one. You've got tailwinds that I don't think are going away anytime soon. What else are you looking at?
Excellent. Thank you, Anthony. I've got a short. I'm going to breeze through this one. Western Digital Corp, WDC, $16 billion, IT hardware, storage, and peripherals. So it develops, manufactures, sells data storage devices globally. Hard disk drives and solid state drives, that's for computer devices, notebooks and PCs. Smart video gaming consoles and set-top boxes. Flash-based storage products for mobile phones, tablets, and wearables. And of course, data center. They have got a cloud business, their best performing part, not surprisingly. Exposure to automotive, Internet of Things, consumer products, industrials, and connected home applications. So it markets its products and solutions through original equipment manufacturers, distributors, and retailers. 3 segments is how I think about this stock. Cloud, business to business, business to consumer. Clients will involve AMD, Broadcom, Microsemi, Microsoft, Oracle, SAP, Marvel, I could go on. Main competitors, Intel, Micron, Samsung, Seagate, and Toshiba. They've just reported Q4 2022. So you look at 22 numbers and they're okay. Revenue up 11, earnings up 80. But when you look at 2023, they've just obviously had a massive downgrade of earnings and revenues, and we've seen this throughout the semis complex. So now as we look into 2023, there's no point looking at 2022. We're seeing revenue down 18, earnings down 70. Now, they do recover slightly in 2024, but 2024, like, what's the point of even looking? In the uncertain world, all it shows is there's going to be an improvement from the current, which is not really helpful. We're trading 1 to 3 months, maybe 4 or 5 months. We're trading the now, and we're looking 1 quarter down. So they've had a massive downgrade, 23, both revenue and earnings. Now, their cloud business, now when we do look at the last quarter, you can see their cloud business has picked up. It was up 18% quarter on quarter. That's up 5% only year on year. Now, cloud is where the investment, enterprise value investment is still solid, and probably rightly so, and will continue potentially, right? But they're really underperforming. And in these hardware businesses, if you're really underperforming and the competition is clearly bigger, arguably better, gaining market share, a bit more pricing power, you're in a really bad spot. And it's not something you can turn around. If you're losing market share in a critical growth area, it just means you haven't got the right product. And to turn that around is not a 1 quarter, 2 quarter, 3 quarter. So yeah, the rising tide lifts them a little bit. But I think this is a weakness in their business. Without it, it's really bang in trouble. When you look at their client business, down 5% quarter on quarter, that puts it down 14% year on year. So what does that mean? The deceleration is happening. Everything's decelerating quarter on quarter. And now the guidance is shocking. Consumer business, 9% down quarter on quarter. It was 23% year on year. So again, it was like at 14 after 3 quarters, and now it's dropped another 9 in the last quarter. Everything is decelerating. Rate of change is always the same. And this is when you've got to really, read what you read. So from Q3, the CEO said, we believe that the secular demand for storage, and new products will drive growth. Well, I don't necessarily disagree with the first part of the sentence, but this guy's running the company, and now, 10 weeks on, wheels have fallen off. So we can listen to what they say, we can be aware of it, and then we can decide whether we think that's a likely outcome. So basically, all sequential movement is accelerating to the downside, we've got to think about why this stock's going to rally. What's going to make me wrong? Well, the growth area cloud, I said, though, this is underperforming, losing market share. Whatever the enterprise value investment on the cloud storage and data management is, I don't think they're going to grow their market share. Customer concentration, they have a lot of large clients. Okay, any switch would be pretty catastrophic for the business. Huge competitions leading to average selling price, ASP, declining in their key markets. So although the stock is back towards the lows, although they've already guided, the market's often saying, NVIDIA, it's kitchen sinked its numbers, it pre-warned, sales down 15%, I bet they beat them, as if that means the stock deserves to be bought. It's all about whether you think there is a probable likelihood of their business conditions improving and their key performance indicators improving. And I'm calling continued deterioration. Their margins are down. Their volumes, I think, are going to be falling, right? Their key markets are weakening. I don't see any reason why they improve. And no one's buying anything on a valuation basis, right? So whatever the PE is, 17 falling to 8, doesn't come into this calculation. It's about continuing to disappoint profits warnings. So balance sheet, quick chat, 7 billion of debt, 2.3 billion of cash equivalents. It was negative cash flow in the last earnings, but that's not really an issue, okay? It's not going to get really badly squeezed on its debt. What its leverage does do, though, is it really limits their ability to do more acquisition. So if we're saying organically they're in a tough place, and I think it's getting worse, I don't think they're going to be able to trade their way out of it by doing more deals. So again, I think this, to me, shuts the door for a transformational deal. Stock's obviously fallen a bit since I've had this on. Stock's at 45. My price target was always 35. Next earnings, which will be Q1 23, comes end of October. So if you just do a November vertical, 45 to 35, it will cost you $2.80. So $3.50 for the long, credit of 70. You're in for $2.80. These can be worth 10 as a max, right? So you'll make whatever that is, $2.80. So $6.20 on a $2.80. You make 250%. If you want to have a bit more fun, if you want tail risk, it depends on the makeup of your portfolio. Go out of the money, buy the November 40s, sell the November 35s. You're basically in for $1. So your break even's 39, stock's 45, and then you'll get a 4 for 1. Nice and simple. Western Digital Corp.
Good stuff, guys. Let's finish up there. It's been another fantastic show. Tons of depth in there from you guys this week. So that was great to hear. Thank you both for coming on today. And, it's been a pleasure. And I look forward to catching up with you guys shortly on another episode. For all of you watching, do remember to visit our website, itpm.com, if you want to learn more about trading and managing your own money successfully. Up there, we've got lots of different content like courses and mentoring programs, which will allow you to kind of generate and execute trade ideas like these guys, Ed and Anthony, have demonstrated in this What's on Your Mind episode. So loads of stuff up there available for you guys. I suggest you check it out and start on the path to learning how to trade with ITPM. But that is it for today. I hope you guys all enjoyed the show, and make sure you catch us in a few weeks' time for another episode of What's on Your Mind.